let's get going, guys. Okay, morning everyone. Just a brief recap on something we did last week and maybe some discussion around it to get you going this morning. I hope that the long weekend and the lovely weather was not too badly ruined by doing your coursework. Sorry about that, but hopefully you didn't find it too difficult. Okay, so we talked last week about the how to value a house in London or an apartment using the Gordon growth model. So somebody remind me what the equation was. So this is the value of the house. What goes on top? This is just a Gordon growth model equation. What goes on top? Sorry? Cash flow, very good. Yeah, something to do with the rent. We called it D because that's the way the Gordon growth model is normally written. And on the bottom we had two things on the bottom. What were they? It's a very simple equation, guys. Remember this. Yep, somebody? R minus G. Okay, very good. Okay, now. Okay, there is a house opposite. A friend of mine lives in Knightsbridge, and opposite his house is a large house, 7 bedrooms, something like that, probably worth in excess of 10 million. And it recently traded for, I think, in excess of 10 million pounds. Okay, but it has been lying empty for the last 4 years. The lights go on maybe twice a year. Somebody turns up to clean up. Maybe once a week there's a family. The guy thinks that they are from somewhere in the Middle East who come in and use it. But it basically lies empty, right? So no rental income. By definition, no growth in rental income, no cash flow, no nothing. In fact, outgoings, because you have to pay for the council tax and, keeping the lights on and having somebody go and clean up the place. So there's maintenance costs that go along with it. But this house is lying completely empty. It's not used, but it still trades for 10 million pounds. It's got zero cash flow, right? What's going on? What's driving the value of that house? Sorry? Comparables, yes. But remember that there is no current use being got by the owner. So why do you think the owner paid the 10 million to leave the thing lying an empty hulk in the middle of one of the most expensive real estate areas in the world? Possibly, yeah. Good point. So there is some expectation term here that you need to put in, right, for capital gains. And as soon as you put something else in here, that becomes what economists call a portmanteau model, which means in French it's a cupboard or something. It means you can put everything that your model doesn't explain into that expectation term, which captures a whole amazing variety of different things that go on to drive the purchase of an asset. Okay? Let's think about some of those things. What do you think is driving this gentleman? Let's assume he's from Saudi Arabia to buy this house and leave it empty for 10 years. What do you think is driving his desire to purchase this house? We talked about this briefly last week. No current value, no current income. It's lying empty. Why does he want this house? Yeah, luxury good, too rich to care kind of thing, right? Just doesn't make any difference. Let's think about a more substantive economic rationale. Yes, please. Something bad happens. Middle Eastern political risk, very good. That's exactly right. So it's a diversification of political risk for this individual. Hard to model that in your valuation model. The point behind this discussion is to show you when you can write a very neat model, right? But you need to think about what else might be driving the value of a particular asset. Okay. Let's go through some thought experiments. What do you think would happen to the value of that house for that individual if the government of the UK, as it has done recently, gets very intrusive about the source of funds for the purchase of the property? What if they want to know everything about where you got the money from to buy a house in London? This is a real life example. The government has just done this, right? They have just wanted to know in great detail, if you purchase a house in London, where did you get the money from? Is it taxed? Is it legal? Are you a terrorist? Are you a gun runner? Are you a drug dealer? Where did the money come from? Right? What do you think that might do to the value of a house in London? Quite regardless of who's living in it and what the income stream currently is. What does that do to the value of houses and property in London? Not a hard question, guys. Does it make it go up or down? Down, right? If you're not to pick on any particular nationality, but this has been focused on Russians, and the government now is very keen to establish that if you're a Russian with a large property in London, they want to know where you got your money from, and in the current climate where there is a bit of, because of the sort of chemical poisoning thing in Salisbury, because there's a sort of climate of hostility towards Russian money, this has now become a big feature. There's an enforcement of crime directorate that is going and looking at houses. Okay? So I think my point about real estate, and actually generally about assets, is that, you know, people, sensible, highly trained people, and as a first step, you have to do this. You have to make sure that there is some real inherent economic value in the thing. But there is a whole host of factors that it is almost impossible to model, but you have to be aware of in coming up with your pricing of assets, right? Not many people in the business school will teach you about things like safe haven demand for houses, right? Diversification. Not many people will talk about money laundering and the fact that that might have a demand, an impact on the demand for houses. Not a pleasant thing to talk about, right? We can all question its morality, obviously, but the fact is there are these extraneous non-economic factors that drive the value of a house, okay? And indeed of any asset, and this is where some of you will learn about this in behavioral economics. Now, just as a small digression, and we'll talk much more about this when we discuss real estate, but supposing you wanted to buy a real estate asset, right? I'll give you a real life example, and some of you can go look it up, okay? This was for a large, I think it was a large foreign, either a family or a sovereign wealth fund that wanted to buy the Burlington Arcade in central London. Anybody know where the Burlington Arcade is? It's on Piccadilly. Very nice, posh shopping street. And the fascinating thing about that arcade is that it trades not only on the expectation of income, right, that you get from it. So shopkeepers in there will pay you rent, and they will, you know, a purchaser will buy the property, will receive those rents. But it turns out that the Burlington Arcade, because it's a so-called trophy asset, right, which gets into this expectations term here, I'll write it down, because it's sort of a prized asset. Yeah, it's something that everybody wants to own. It trades at a value that is probably far in excess of its current rental yield, and the rental yield's ability to service the debt that you might take out to buy the property. So it traded apparently at something like a 2% yield, which means that all of the rents, when you add them up, were equal to 2% of the property at a time when financing costs for this kind of property were 3 or 4%, right? So immediately, if you're buying the property based on leverage, you're facing a cash flow, short-term cash flow loss, right? But the only reason to do that, it seems irrational, right? Why would you buy a property that is giving you 1.5% in return, but you're having to pay out 2.5%, 3.5%, 4% for in financing costs? Well, the only reason that you would do that is because you've purchased a trophy property in the middle of London. Now, if you were sitting in a trophy property in central London, and you are quite happy enjoying the asset for the first 2 years, you're getting your rental income fine, everything's working out, and then all of a sudden, on the 23rd of June, 2016, the people of the UK vote to leave the European Union. Are you happy or sad as the owner of the Burlington Arcade? It's not a hard question, guys. So you own a very prime property asset in central London. Brexit is announced. Are you happy or sad? Very sad, right? Because the initial thought was, long term, this may be very good for the UK economy because it's freed from the quote-unquote shackles of Europe, which is what the levers will tell you. But in the short term, there was bound to be a period of economic uncertainty and some digesting of the fact. You may recall that on the day that it was announced, sterling collapsed from 150 to 130, I think, and then went down to 125. So you're feeling pretty sick about this. Now, had the asset, especially because you are receiving 1.5% in rental income, you're having to pay out 3%, let's call it, in financing costs. You've got a cash flow deficit, and all of a sudden the capital value of the thing has just taken a big hit, right? So you're very unhappy. You can kind of take that cash flow shortfall if you have the expectation of a gain in the long term, but if all of a sudden you have an external shock that depresses the expected capital appreciation here, right? Your calculation of value suddenly becomes very different. My point here is I'm sort of going over this a long time. All of the very stylized and very precise models that you've learned in finance theory at the business school are incredibly useful. They're ingenious. They're a systematic framework for understanding what drives value, for pricing securities. They are widely used. My only plea to all of you is just be careful, because there are some things that drive value in the long term that are very hard to model, but you've just got to be aware of them and be able to speak intelligently about them. And in particular, you have to take asset management decisions based on things being in pricing behavior that you cannot model. Okay? So just if there's one or two things that I'd like you to take away from this course is, one, obviously I've already said, right? Finance theory is incredibly valuable. It's a precise, ingenious, systematic framework for taking a very complicated market and giving you some sense of the understanding between risk and return and volatility and price, right? But there are a lot of other things going on that may drive value, and as practical people, you should be aware of them. Okay, good, guys. I hope you're now, from this early morning start, all fully awake after that little exercise. So let's get into the main part of the lecture. Today I'm going to talk a bit about, we've had a lot of theory. Today and the next few lectures are going to be very practical. It's going to be about how this actually works in practice. I'm going to ask you your views on some aspects of the wealth management industry, how it all works, wealth and asset management. I'm going to try and teach you some of the language of investments, which is very different from the language of textbooks. And the second part of your exercise, your coursework, is going to be an actual fund selection exercise. Have you seen those pages at the back of the Financial Times with pages and pages of numbers? What are they? What are they? Who's read the FT today, as I urged all of you to do? Actually, I must confess, I didn't read it this morning because I was too busy preparing for this lecture and making sure I was in tip-top form, but I will read it when I get home. But what's on the back pages of the FT? There's a list of funds. That's what I was looking for. There's a tables of funds out there. For those of you who haven't read the FT, go pick up a copy. go to the very back pages and look at the description of funds over there, right? There are literally hundreds of funds. In fact, somebody was telling me the other day that there are more ETFs, which is a particular kind of fund, by a multiple than there are individual securities in the global markets, which is an interesting thought. In any case, there are a lot of funds there. They have prices, they have values. People buy them to try and manage their intertemporal choices, to make investments, to defer their consumption. They buy them for all those good reasons. But how do you choose? Given that you've got so many hundreds of funds out there, if somebody asks you, should I buy the Fidelity S&P fund or the JP Morgan fund or the BlackRock fund, how do you choose? Your second coursework is going to give you some of the tools to be able to answer that question. So that when you look at all of the funds at the back, and they're all well marketed, they're all well presented, the people that manage them typically have good CVs, how do you choose? The coursework is going to help you with that. So the second half of this course is actually pretty practical. But if I'm doing my job, then you will find that all of the theory that you've learned is actually applicable to everything that you do in the second half. Okay? The framework that you've got will stand you in very good stead as you try and navigate the financial markets and the practical world of business. So you've seen this before. But what we're going to talk about today is the global market for wealth. Maybe we can have a bit of an open discussion about where you guys see the opportunities in wealth management today, right? We're going to talk about the threats to wealth, and they come from tax, obviously. Governments are very keen to get their hands on wealth. You may know that France has a particular kind of tax, for example, that the UK does not. Can somebody tell me what it is? Yeah, it's a wealth tax, basically. Yeah, it's a wealth tax. It's a tax on your wealth. Think about that. You're a wealth provider. You want to go into the wealth management business. You've set up shop in the UK, and all of a sudden there is a big tax on wealth. Big problem for you, right? And an even bigger problem for the people on whom that tax is being imposed, right? So these are all threats to wealth, which, as an advisor, you need to think about. One thing that we haven't talked much at all about in this class, and I'm afraid we probably won't except in passing, is taxation, right? An incredibly important determinant of your returns from an investment is obviously the underlying quality of the security or the fund that you buy. But the other incredibly important component of your return as an individual investor in particular is the tax aspect, okay? And in particular, uncertainty in taxation drives a lot of decisions at the high end of the wealth market. The reason that Switzerland is such a popular destination, and Monaco, you know, you've seen the yachts in Monaco, is because there is a relatively stable, relatively predictable, and in most cases pretty low level of taxation, which attracts people to go to those destinations. Right? So I haven't talked about it, but as a practical matter, if you're ever considering an investment and one has a more favorable tax treatment than another, and indeed your after-tax return from one investment is higher than the other, even though the pre-tax return is the other way around, you need to consider that when you're making individual recommendations. In the institutional market where pensions and things are concerned, it's not that important because a lot of these things are tax-deferred plans. But think about taxation when you're looking at investments. One obvious example is that the rate of income taxation is usually significantly higher than the rate of capital gains taxation, right? In many countries. It's the case in the UK, it's certainly the case in the US, and many countries do that in order to encourage investment for the long-term capital gains tax. One of the great things about funds in some countries, equity mutual funds, is that even if those funds are paying a dividend, it sits in the fund, and you don't actually pay income tax on it until you sell the fund, right? And then you have to pay a capital gains tax at a lower rate. So one of the advantages of buying a mutual fund is actually that occasionally it's a tax-advantaged way to invest. And you just need to be generally aware that taxation is a big deal when it comes to matters of individual investment, not so much institutional investment. And indeed for yourselves, when you're thinking about planning your own financial future, it is incredibly important to think about taxation. In many Western countries, well, not many, but in the UK and the US, interest paid on a mortgage was tax deductible, right? It still is in the US to a certain limited degree. It was completely eliminated into the US, in the UK. If the government is giving you a tax incentive to borrow, what do? You borrow more, right? And conversely, when the government takes away that tax incentive to borrow, as it did in the UK, you have to think about the impact of that on the housing market. If you're a purchaser of a house, you know that the government is eliminating the tax deductibility on mortgage interest, you should probably wait a bit, right? So what I'm trying to give you a flavor of is that making investment decisions, there are many dimensions to it. The models are fine. They're useful, they're essential, they're a solid bedrock, but you really can't rely just on them. You could go very badly wrong. You need to think about the broader context in which these things operate, right? Tax is a very big deal for investments. We'll touch on how people preserve wealth for the long term. Anybody know what a trust is? Yeah, a good way of describing it. It's yours, but it's not yours. So it is a way of transferring the ownership of assets into a vehicle, a legal structure, right? So you take your assets, you don't formally own them anymore, they're in trust, and they're placed in trust for other beneficiaries, or maybe indeed for yourself. Very popular way for families to preserve wealth over the long term, a very important succession planning tool. Beyond the scope of this course to talk a lot about them, you should generally be aware of what they do. They achieve getting property outside your ownership, property and assets, and into a trust ownership, so it's not actually owned by you anymore, but you still have some control over its future disposition. In particular, you have control over whether you can pass it on to your children. That is a very popular use of them. People who get very rich through companies, their own companies, often put their assets into trust in order to limit their liability in the event something goes wrong, right? So not only is it an intergenerational tool, but if your assets are sitting in a trust and something goes wrong with your company, you're sued by somebody, either an unhappy shareholder, a client, customer, whatever. If your assets are sitting in a trust, it gives you a measure of legal protection. Again, this doesn't come up in the textbooks. In theory, very important in law, and as a practical matter, it's a very important tool for wealth preservation. I'm going to talk about a bit about what constitutes success in wealth management, how you create a successful wealth management business. Question?
Just a question, that in the trust, can you still use the assets like the property and everything else?
Yes. Yes, so the question was, in a trust, can you still use the property? There are some trusts that give you certain tax benefits and advantages from you not owning the asset. And it's important, therefore, not to violate the basic structure of the trust. But they can be structured such that you can have use of the property even though you don't formally own it, right? Now, some people set up offshore trusts as a way, and I don't think it's that doable anymore because the governments and most fiscal authorities have got wise to this. But people in this country used to set up offshore trusts. In fact, the previous Prime Minister, David Cameron's dad, had got a trust for the family, which came out in the Panama Papers, which was a bit embarrassing for him. But some of these trusts, if they are offshore, then they have to stay offshore. So one interesting dynamic that arises, if you're sitting in London trying to manage that fund, right? You're applying what you learned at Imperial and maximizing the return and minimizing the risk. If you're actually doing that activity from London, sometimes they onshore those trusts. They tell you, sorry, you said that this is an offshore asset, but actually you're doing all of the control from here, so therefore we're going to tax you as if it's an onshore asset. So just worth being aware of. Very important in planning a business strategy for wealth is regulation, right? This is super important. When I was still practicing as a private banker last year, there was a whole load of stuff that we had to do in order to fulfill our regulatory requirements. As a banker, I had to be a fit and proper person to advise clients, extremely wealthy clients, very responsible role. And so you need regulation on yourself. You need to make sure that you attend classes like this, actually, to maintain your professional standing, because otherwise you're not considered to be fit and proper to operate as a banker. And actually, funnily enough, part of my even coming and listening to a lecture at Imperial, and in my case, giving a lecture at Imperial, gave me some units for my continuous professional development. Right? So all of you guys who are in private banking or in asset management or indeed in investment banking, and you've got what are called continuous professional development requirements set by the regulator, you might consider teaching a course. You too can do it if you would like. And it's quite handy. It satisfies your professional certification requirements. Very important for businesses. There is something coming along in Europe called MiFID II, which is super important. It's causing a lot of headache in the industry. This MiFID II, this number 2, applies mainly to investment banking, but the provisions of MiFID, the first one, there were very significant things that it said about how you, as a private banker or as a wealth manager, interact with your clients. Worth being generally aware of this, because the regulations can change. They can fundamentally alter your business strategy. Okay? We're going to talk about how you manage concentrated wealth. All your theory will tell you that it's not a good idea, but we observe it all over the place. Many rich people stay, from a risk manager's perspective, horribly concentrated in a single asset, and we'll discuss the reasons for that. It's generally not a good idea, because single assets have got a big amount of idiosyncratic or individual risk. It's usually better to be very diversified. We'll talk a bit about that and some of the costs and benefits of that. We're going to talk a bit about market segmentation. Obviously, you have a very different business plan to target a billionaire from targeting somebody who's got £250,000 as a pension pot, right? Very different business strategies, and we'll talk a bit about that. And then I'll introduce you to some words like advisory, discretionary. We'll talk a bit about needing asset class expertise and credit. I'll talk to you a bit about the role of networks, clusters, buying behavior, and then we'll talk about intermediaries, the people who are between wealth advisors and wealthy clients, lawyers, accountants, other sorts of professional advisors. Okay, now let me give you an interesting, just on the business of the wealth management industry. So I was a coverage private banker for about 5 years, I would say. It was the last thing I did in my career, having done investment banking and other things before that, and actually a bit of research in an investment bank. But in my 5 years as a private banker, what do you think that the question about the markets that I got asked the most was? What do you think the question I got asked most was? The market's going to crash again. Pretty good, yeah. On the overall market, obviously, every day, everybody wants to know whether the markets are going to go up or down, what the future direction is, how do I diversify my portfolio. So that's the whole risk of market questions. But I got asked a question about a single security a lot. And I'll put you out of your suspense. The question that I got asked the most, and I was keeping tabs of it, was, what do you think of Apple